It is Tuesday, November 18, 2025, and the markets are in the thick of a volatile session that has investors glued to their screens. Right now, Opendoor Technologies, Inc., trading under the ticker symbol OPEN, is changing hands at a live intraday price of $7.20. The stock is navigating a choppy session, currently attempting to find support after opening near $7.45, showing an intraday decline that reflects the broader hesitation we are seeing in the interest rate-sensitive technology sectors today. We are witnessing a battle between the bulls who believe the bottom is in and the bears who are aggressively defending the resistance levels just above the $7.50 mark. The volume is already swelling past 57 million shares, indicating that institutions and retail traders alike are actively repositioning as we head into the afternoon trading hours here in New York. The narrative surrounding Opendoor has always been one of high-stakes disruption versus the cold, hard reality of real estate economics, and today that tension is palpable. The expectation from the retail community and the optimists on social forums has been that Opendoor's pivot toward an artificial intelligence-driven marketplace model would finally decouple the stock from the cyclical risks of holding billions of dollars in housing inventory. Investors wanted to believe that by the third quarter of 2025, the company would be showing a clear, explosive path to profitability that justified a valuation closer to its historic highs. However, the reality we are dissecting today paints a far more complex and nuanced picture. While the company has managed to stabilize its liquidity, the recent third-quarter earnings report revealed that the transition is messier and slower than the hyper-growth narrative suggested. The reality is that Opendoor is still burning cash, with a reported net loss of $90 million in the most recent quarter, and the housing market remains stubbornly frozen by high mortgage rates that have not retreated as quickly as the Federal Reserve or the market anticipated. This disconnect between the tech company valuation multiple that investors want to assign to OPEN and the low-margin home flipper valuation that the market is currently enforcing is the primary driver of the volatility we are seeing right now. When you look at the chart today, you are not just seeing numbers ticking up and down, you are seeing a repricing of risk. The stock falling to the low $7 range after flirting with nearly $11 earlier in the 52-week period tells us that the market is demanding proof of execution, not just promises of future AI integration. The recent price action is particularly telling because it comes on the heels of a significant earnings miss, where earnings per share came in at a loss of 12 cents against a forecasted loss of 7 cents. This kind of fundamental disconnect forces big money managers to trim positions, creating the selling pressure we have observed over the last few trading sessions. To understand where this stock is going, we have to look at the technical damage inflicted over the last week. The stock is currently trading below its key moving averages, and the failure to hold the $8 support level last week has turned that price point into a formidable ceiling of resistance. Momentum indicators are flashing oversold, which often tempts contrarian traders to step in for a bounce. But the lack of sustained buying pressure suggests that the smart money is waiting for a better entry point or a clearer signal that the housing turnover rate is actually improving. The macro environment is acting as a wet blanket. Even though Opendoor has reduced its inventory to manage risk, they need volume to make their unit economics work. With existing home sales data remaining lackluster, the company is fighting an uphill battle against a macroeconomic current that they cannot control. Let's pull back and look at the business model itself, because this is where the long-term thesis either lives or dies. Opendoor pioneered the iBuying sector, a model predicated on the idea that you could use algorithms to instantly price a home, buy it from a seller who wants convenience, conduct light repairs, and flip it for a profit. In a zero-interest rate world with rapidly appreciating home prices, this was a license to print money. However, in the current environment of 2025, where capital is expensive and home prices are stabilizing or undergoing a correction in certain overheating markets, the margin for error is non-existent. The company has wisely shifted strategy to include more partnership programs and an asset-light marketplace approach, where they connect sellers to buyers without taking the home onto their own balance sheet. This is the expectations part of the story. Investors love the idea of a software margin business. But the reality remains that a significant portion of their revenue still comes from the capital-intensive buying and selling of homes. Until the marketplace revenue overtakes the inventory revenue, the market will treat OPEN like a risky real estate play rather than a high-growth tech platform. Now, we must address a critical component of the current trading dynamic that every investor needs to understand: the short-selling activity. Opendoor has become a battleground stock for short sellers. Current data indicates that the short interest is hovering around 24 to 25% of the float. This is a staggeringly high number, and indicates that a quarter of the available shares are being bet against. When you see short interest this high, it creates a distinct mechanical possibility for a short squeeze. But it also tells you that sophisticated funds have high conviction that the stock has further to fall. The borrow rate is currently relatively low, sitting under 1%, which means it's cheap for bears to keep their short positions open. They are not being forced out by high fees, so they can afford to be patient and wait for the stock to grind lower. But you need to watch the days to cover metric. With the high volume we are seeing today, over 50 million shares traded, the days to cover ratio is quite low, meaning shorts can exit their positions quickly without causing a massive price spike if they need to. But if volume dries up and the stock price starts to tick up on positive news, those short sellers could be trapped. You should be monitoring the fails to deliver data in the coming weeks. If we start seeing a spike in fails to deliver, it often signals that naked shorting is occurring or that liquidity is tightening, which can be a precursor to a violent move to the upside. For now, if you are long this stock, you are fighting against a very crowded bearish trade. The actionable insight here is to not chase a breakout until you see a confirmed close above that critical $7.80 resistance level on high volume, which would signal that the shorts are beginning to cover. This high short interest feeds directly into the retail sentiment we are seeing online. If you visit the major stock discussion boards or browse finance threads on X and Reddit, the conversation is polarized. On one side, you have the squeeze hunters, who are convinced that Opendoor is the next major reversal play, citing the massive cash pile on the balance sheet as almost $1 billion as a safety net that justifies a higher floor price. They argue that the company is priced for bankruptcy in a world where they have enough runway to last for years. On the other hand, you have the fundamental bears who argue that the business model is structurally broken and that the company is burning cash to keep the lights on. They point to the insider selling and the lack of clear profitability as evidence that the stock is a value trap. This polarization is healthy for a market because it creates liquidity, but it also means you need to filter out the noise. When you see posts screaming about a moonshot, check the volume. If the stock is up 5% on low volume, it is likely a trap. Real moves require institutional participation, not just retail hype. Comment below how many shares of Opendoor you currently hold and what your average cost basis is. Are you averaging down at these levels, or are you waiting for the company to